and welcome to Invest Africa, a webinar looking at the future of DFI activity in Africa. Now I'd like to hand over to Joanna Turner, the partner at Control Risk, with whom we are partnering on this webinar. We are delighted to have Joanna on, who is based in Nairobi and whose work focuses mainly around DFI activities in Africa. So Joanna, over to you.
Thanks very much, Alex, and good afternoon to everybody here from Nairobi. Thank you very much for joining. As Alex said, we've got a really fantastic panel with us this afternoon, so hopefully we can really delve into some of the issues I think that some of you have already asked before, and some of the really kind of topical questions that are important very much in this post-COVID time. Our panel has a wealth of experience across Africa and some really in-depth experience in some specific countries in Africa, and it spans really across the investment, management and operations side. So I think we'll get some really interesting discussions. So let me introduce our panel today. So to begin with, we have Franziska Holman, who is the Director of Corporate Finance at DEG. Franziska is responsible for new business development and for structuring and managing a portfolio of corporate clients. Prior to this, she was Director of Agribusiness globally at DEG, so has very deep experience in that sector. So welcome, Franziska.
Thank you.
We have Sanjeev Gupta, who has my name on his window, but is actually obviously not me. He is the Executive Director for Financial Services at the Africa Finance Corporation. His responsibilities include treasury, trade finance, debt syndication, country and investor relations, and financial advisory. So welcome, Sanjeev. We have Michael Awori, who is joining us also from Nairobi, who is the Chief Operating Officer at the Trade Development Bank, or TDB. Michael leads the bank's operations, and he also leads on the trade finance and project and infrastructure syndicates as well. So welcome, Michael.
Thank you.
And finally, we have Mohan Vivekanandan, who is the Group Executive for Origination and Client Coverage at the Development Bank of Southern Africa. Mohan holds responsibility for deal origination, client relationship management, and has specific focus on transport, ICT, education, and health sectors. So welcome, Mohan.
Thank you.
So I thought it would be useful just to kick off with a slightly broader discussion around the role of DFIs during the COVID crisis and in the immediate post-COVID recovery, and the important role that they've played supporting the private sector. So I really just wanted to start, maybe Franziska, if I can kick off with you. Why do you think DFIs have been so important during this crisis? What role have they played, and why has it been so important?
First of all, thank you very much, Joanna. Thank you very much to Invest Africa for organizing this fantastic webinar today, and good afternoon to all who are listening and participating today. Well, DFI times are always times of crisis. In times of where the economies are booming, of course, DFIs have a very important role to finance the expansion and the growth of the economies. But this is maybe less challenging than when a crisis appears, when many players have to turn down their activities. They have to take care of the balance sheet risks. There are the regulators which restrict a little bit the new business. So in this situation or such a situation is when DFIs are most needed, because DFIs are always there. They go through all the crises. They stay in the markets. They don't run away when things become difficult. We as DFIs, we have seen so many different crises as an institution in many years: a regional financial crisis, political crisis. So now we have a health crisis, which is new for all of us. and also has a very specific challenges. But nevertheless, it boils down at the end of the day to an economic crisis, a human and economic crisis. So it's not too different from others. What is the role of DFIs? First of all, we are there to stabilize the economy and the private sector in particular, and how we do this. How do we do this? First of all, by supporting our existing clients through the crisis. So all of us who are joining and all the DFIs have a huge portfolio of existing financing clients. So most important for us is really to support these clients through the crisis, and yeah, make them resilient and help them to recover very soon. We also have an important role to take care or to avoid, hopefully, as much as we can, the social effects of the crisis. So I can come later to it, but we have developed very quickly a very efficient support program and assistance or consultancy program where we offer our clients to get some consultancy on how can they avoid retrenchments, or how can we find flexible and creative solutions to save jobs, to keep the staff maybe at a lower level. And then, of course, we have the role and the responsibility to push the private sector to recover faster from the crisis. I mean, we are still in the crisis, but hopefully very soon we will see the recovery phase. And then we also have to, or already we are also financing companies which have opportunities, and then hopefully help pushing the whole economy towards the recovery. And last but not least, even in a crisis, everybody talks only about COVID-19. There are other very important topics which we should not forget about it, like climate change and environmental and social aspects. And the role of DFIs is also to stick to these targets, not to forget about it, and even through the crisis, in our financings, support our clients to also be environmentally, socially responsible, climate resistance, etc.
Thanks, Francesca. That was very helpful. I'd like to just sort of pick up on one of the points you made there. So you talked about sort of pushing or supporting the private sector to recover as quickly as they can from this crisis. Mohan, maybe I can come to you while we wait for Sanjeev.
No, thank you. I mean, obviously, the crisis is putting a significant, it's having a significant impact, and there's a requirement from DFIs to be able to step in and support, the broader health and economic needs of a country, including the private sector. I think, though, at the same time, the risk that it brings in is it forces you to step into and playing a lot of roles that you may not be best suited to play. So I think it's quite important for DFIs as well to try and still stay focused on your core mission, but just try to do more of that as well, which is one of the things that we've tried to stay focused on. If we step back and we look at the impact that the crisis has had on us, because I think it's a good starting point, the worry that we had in March was that, one, we were going to see significantly higher rates of non-payments or delays in payments and requests for delays from our clients. And we also saw that the market for liquidity in Africa had really been impacted. Our cost of borrowing had gone up by a couple of 100 basis points. The RAN market, the ZAR market has really frozen, and it's still pretty much frozen, especially for medium and long tenor financing. the Development Bank of Southern Africa, we're a national DFI of South Africa, but we have a Pan-African mandate. We invest about $1 billion a year in long-term infrastructure investments, of which about 40% of that is outside of South Africa. And we found that our ability just to be able to make sure that our own book was in order and our own house was in order was a critical element in the first month or two. And we did see ourselves pulling back a little bit, which is really what we didn't want to do. But you've got to ensure that as an entity that's separate from the state, that your own balance sheet is protected as well. But quite quickly, within a month or so, we were able to work. We were able to partner also with our global development banking partners, entities like KfW, the parent of DEG, AFD, the New Development Bank, and others, to be able to access liquidity from them, which we were then able to utilize to on-lend so that critical infrastructure projects don't get delayed too much, both in South Africa and in the rest of the continent. And so that's one of the elements we've been able to do, is act as being able to access sources of global capital and then be able to channel it towards critical infrastructure projects, especially on a long tenor basis. As an example, ourselves and TDB had jointly funded the second phase of the Tanzania standard gauge rail project. KfW had provided us funding to be able to conclude that transaction, and we were able to provide a 15-year loan to the government of Tanzania for that project. So it's long tenor as well. The other element is, as a national DFI of South Africa, we've been working very closely with the government of South Africa to pivot, to continue to deliver infrastructure, but to do it not through the national fiscus, which had been the mechanism previously after the global financial crisis, but to try and do it a lot more working with private sector investors. So in sectors like energy, transport, bulk water, and in telecoms, ICT, even in student housing, in health as well. In all of those sectors, we worked with the South African government to develop a program that finds ways to crowd in both equity investors from the private sector and long-term debt investors as well, from institutional investing. And that also is a way to allow private sector to come in and participate in these sectors. So those have been two of the mechanisms that we've utilized.
Great, thank you. And I think that you touch on an interesting point there. I think, we focus a lot on what we're doing with the private sector, but I think also thinking about how you're working with governments and, the role that DFIs can play in partnership with government is also really important. Sanjeev, I wondered if we could try coming back to you on that point. Can you hear us?
Thank you very much, and thanks for being patient, Joanna, and apologies for putting your name on my face. It's not fair on you, I know. So apologies for that. Never should be done again, which is probably why I wasn't allowed to speak after that.
No problem. Well, we're thrilled to have you here now. I wondered if you could comment on that point exactly about, I think there's obviously the support for the private sector and boosting or crowding in the private sector in this post-recovery period. But what role have DFIs got to play in terms of working with government and working with governments to get through this really challenging time?
Yeah, so Joanna, the thing that I would like everybody to understand and appreciate and remember is that DFIs have a role to play always, right? It's not only now that the DFIs have a special status. The DFIs were created because there was a gap, right? Now, when you look at the African continent, I think we will do well to remember, and this is very important, that there is 3-4 things that always plagued us and will continue to plague us, and COVID has just kind of exaggerated it, if you like. It's not necessarily created it. And that is that there has always been a singular lack of domestic savings that can be translated into long-term capital on the continent. There has been a singular lack of capacity in terms of project development. There has been a singular lack of government's financial ability to fund large, economically important projects because they haven't had the funding themselves. And capital markets in general in Africa, with the exception probably of a couple of countries, has always been very, very narrow, very shallow, and therefore not able to provide capital. So what COVID has done, Joanna, is kind of put it all into a very sharp focus, because all the things that has structurally been an issue on the continent was brought into sharp contrast during this period. So as Mohan said, or as Francisca said, that this has allowed DFIs to not only raise their hands, which is important, but to actually act as a bridgehead between the opportunity that clearly exists and the crisis that unfortunately COVID has created on one hand, and global capital on the other hand, which with the extraordinary amount of stimulus that is now currently in place, looking for commercially positive returns. I mean, it stands to reason that global capital will have to find returns finally. And where will it find returns except in a continent which can actually provide returns? So if you understand the macro picture, which is a dominant picture, and it's been a picture for years, then you will understand why DFIs have a role to play and the role we are playing. So as Mohan said, quite simply, we are in a position today, given our credit ratings, given our multilateral status, given our access to global capital, to bring capital in. Because capital into Africa is only coming from global sources through certain institutions only. Credit has pretty much dried up at a lower level. So what are we doing? We are acting as the source, as the mobilizer of capital, and then deploying it. So for example, in the peak of the COVID period, Joanna, AFC managed to go into global capital markets and do a Eurobond issuance, where we raised $700 million of new money at 3.12% in US dollar terms. Unheard of. Nobody would have expected it. And the reason why we got it is because we have a rating. It's single A, and people want to put money through us. And what do we do with the money? Systematically look at the need from the sovereign's point of view, look at the need from the commercial bank's point of view, the need from a trade finance point of view, and see how we can allocate that. So that's how we kind of played the role, and that's exactly how it's going to be. In terms of our core interest, which is infrastructure, which is really about project development and early and long-term investing, that continues. Nothing changes. In fact, we have become more committed to the continent because we see more opportunities as a result of COVID, not less. Thank you.
Thanks, Sanjeev. And can I just come back to you on one point there? So you were talking about the needs, I think, and the DFIs responding to those needs. How do you think the needs have changed in terms of beneficiaries? So obviously the DFIs have a kind of, a development impact agenda as well. How do you think that has changed immediately post-COVID?
Well, obviously, what has changed is that, admittedly, there is a larger expectation from DFIs, from everybody on the continent around being able to provide immediate support for COVID-related challenges and for providing liquidity to the banking system, which is dried up, and to provide governments with much needed foreign currency. So that's been the shorter term impact, if you like, and therefore the raising of the expectation bar as far as DFIs are concerned. But fundamentally, please remember that if you really look at how Africa has been funded over the last couple of decades, DFIs have increasingly played a role, and therefore that, to that extent, the pressure that's on us is nothing new.
Yeah, I can see that exactly. And I think, Michael, it would be good to come to you. We haven't talked much yet about the trade financing aspect of it, so I think it would be useful to get your thoughts there. And obviously, I know that you have a project infrastructure oversight in your portfolio as well, and Mohan talked about the need to stimulate the infrastructure sector as well. Could you give us your thoughts on how this has affected trade finance and whether this is affecting your strategy going forward?
All right, thank you, Joanna. Certainly, the impact of the COVID-19 pandemic has really disrupted value chains and trade cycles globally, really sort of turned the world upside down. And certainly the trade finance segment has suffered quite greatly. There already was a significant trade finance gap. And this COVID-19 pandemic, as Sanjeev mentioned, has sort of pulled back a lot of capital that would have been coming to Africa and really exacerbated some of these trade finance gaps. And this has sort of picked up on something that had been happening already for quite some time. We've seen, particularly in the trade finance space, some of the global correspondent banks pulling back from Africa, from financing trade in Africa, for a number of reasons. Again, the pandemic has really accelerated that. And TDB, as you mentioned, having a very large part of our portfolio being in trade finance, we've been playing an increasingly critical role to addressing that gap, really working through a lot of financial institutions across our region, and really addressing the trade finance gap, as well as the foreign exchange challenges across our region. So, we've been doing this through providing a range of products and services to FIs, from direct support, such as trade loans and liquidity support, to unfunded solutions, such as letters of credit confirmation and reissuance. And through these interventions, we've been able to help avert fuel shortages. We've been able to help secure the sourcing of strategic commodities and facilitating greater intra and inter-African trade and regional integration. And during the pandemic, if anything, we've ramped up those interventions, again, to support things like the importation of vital commodities such as wheat and grain and fertilizer, serving to ensure that our region's food security is enhanced, enable our economies to again have critical inputs such as fuel, so that economic activity can continue, and again fertilizer to enable our farmers to continue to enhance productivity levels in agriculture. But I'd say beyond just using the financial capital, we've been also working with FIs in non-financial measures such as capacity building, right? We've working with some of our partners, hosted a East and Southern African banking seminar over the last couple of years. We'll be bringing leading FIs and MFIs and SMEs and provide sort of training on best practices and lessons learned, sort of leveraging our intellectual capital to ensure sort of long-term sustainability for this sector.
Thanks, Michael. That's a really interesting point. And actually, I mean, that's part of what we do in terms of supporting the DFIs, is around that kind of non-technical support, either it be kind of training or, we've done some work around assessing risks or developing kind of risk assessment methodologies for portfolio companies who are looking at the risks from COVID. Francisco, I wondered if I could come back to you, and it would be great to kind of understand how DEG is looking at providing some of this sort of non-technical support to some of your corporate clients and your investee companies, and how, whether that's changed or whether you've changed the strategy around that recently.
Yeah, happy to do this. I mean, even many years before COVID-19, we developed a so-called business support services program, which is a consultancy program which is very much focused on the needs of our clients. So it's maybe different to other DFIs who call it technical assistance, which is usually very much environmental and social issue related. We call it business support because we want to address all needs of a client, of the management, to improve the business, to make it more sustainable, not only environmental, social, but also economically sustainable. Because we are very much convinced that that only economically sustainable clients, and this crisis shows it even more, are able to survive such a crisis and are able to deal with the challenges of this crisis. As Sanjeev said before, this crisis only sharpens structural issues, but not only in governments. We see it also in corporates. Corporates which had structural issues, which had corporate governance or transparency issues, are much less resilient or much less prepared to deal with the crisis. But now coming back to these programs, when the Corona or COVID-19 crisis started, we have immediately structured new programs and new consultancy measures to, well, first of all, to address all challenges of the Corona situation. So, for example, for our hospital or in the healthcare sector, our clients, we developed support measures, consultancy to well, first of all, to train the employees, the community, to develop disease or pandemic emergency plans. We can also use these funds, and these are grant funds. We can also use this to finance, simply to pay to cover the costs for testing material and well, disinfection stuff and masks, etc. So to a certain extent. So this was like immediate emergency support and is still ongoing. Then what I mentioned before, we developed a very useful consultancy program where our clients can use to brainstorm and to discuss what can they do, how can they prepare themselves to keep the staff as much as possible. I mean, there's not only black and white. You can not only either keep the staff or let them off. I mean, you can maybe find creative and more intelligent solutions, and also check what is available, what is possible. And this consultancy measure is consultancy instrument is gratis, so our clients can just use it and discuss with human resource department and these experts their ideas and their problems, and then hopefully find a quick solution. And then in terms of liquidity support, there are several programs. One is for European clients. They can apply for the so-called Africa Connect program, where we created an immediate liquidity support line for Corona liquidity needs, and the European DFIs have also expanded an existing program, which was existing before. It's so-called EFP program, and they extended this program. It's a new COVID window, added new partners to this syndication program, and also extended the terms and conditions to be more flexible. While these are the main, I would say, the main and most important changes. All in all, we have invested in this support program 7 million euro as grant money, and 25 consultancies could also be successfully concluded. We did 200 quick assessments on job and retrenchment plans with, well, and now the consultancy measures are ongoing.
Great, thanks, Francisco. And that's very interesting. Actually, we just did an article actually looking at some of this non-technical support and how impactful that's been, I think, in terms of supporting portfolio companies in the short term. And that's been such a kind of important role that the DFIs have played of that. Sanjeev, can I come back to you on this? I mean, in terms of general strategy or kind of specific activities or additional activities that the AFC has taken to support some of your investees, can you talk through a couple of those and how impactful you think that they've been?
Yeah, I'll do that, Johan. And thank you very much again for the question. Because you know, the AFC business model is such that in many ways it kind of attempts to address the basic structural challenges that we have on the continent, right? Which is why we do a lot of early stage project development work, which is really where you provide not only advice, but you also provide early stage insights into how a project should be structured and how risks need to be mitigated and what sort of public-private interventions need to take place for private sector capital to be able to come in. So PD to us is almost an all-encompassing function that allows us to create projects that finally investors will find bankable, right? Then, of course, we do equity and debt, which we all know about. But where we also then try and add value, Joanne, is that one of the largest risks and one of the largest matters that anybody talks about when they talk about investing in Africa is the exchange rate risk, right? So again, we try and play a role in neutralizing that by creating certain structures which takes away exchange rate volatility from the returns of global lenders. It can be done through various structures. We've done it. And again, that's an area where we think we add value because institutions like us can add value in that respect. The third is what I call the ability to mobilize. Because once you've structured a project properly, once you've de-risked it, once you've sliced and diced it to meet the different risk appetites of different groups of investors, it then allows you to go and mobilize significant amounts of money from outside to come into the continent. One example is a project we did a couple of years back, where we refinanced a large refinery project in West African country. And the way we finally sliced and diced it meant that a large portion of that money, that lending that we required, came from European pension funds, right? So just to give you an example, that they were not coming into the continent, but we could bring it in because of the ability to structure. So that's, again, an area where we feel ourselves needing to add value, right? Because project development, yes, but how do you structure it for different sources of capital to come in? The other thing is credit enhancements, John, that again, very often the credit itself is challenged, right? However way you slice it or dice it or structure it or don't structure it. So again, we need to bring in insurance in certain cases. We need to bring in blended finance solutions in certain cases to create a pricing that is palatable. We need to provide swaps and hedging programs around which investors can come in. So again, an area where we add value. But the one thing I will say to you, which is something we are increasingly finding a very important part of how we do business, is changing the narrative on Africa, right? And I don't mean it in a PR sense. I mean it really in a sense that if we as DFIs cannot encourage global governments and global corporates to look at Africa as a continent where industrialization has to take place, where value has to be added to the minerals that is being exported out, where value has to be added to the agricultural products that is otherwise being exported out with no processing, then you're ultimately doing a disservice to a continent. And maybe COVID does us a favor now, Joanne, because COVID hopefully has made people realize how dangerous it is to have a concentrated supply chain. And what we are trying to do, and certainly going to try and do more of, Joanne, is to see how we can change the thinking of global corporates for them to move more and more of their processing, manufacturing into the place from where they get the primary goods in the first place. Because that does a lot for Africa. I don't need to be an economist to explain that to you. But what it also does is it creates opportunities for global capital to find returns. So again, it's a soft power type intervention, but it's an important way of adding value as a DFI to the continent's needs. Thank you, Joanne.
Yeah, and I think it's very interesting you bring up that point about diversified supply chains. And actually, I was talking to another DFI colleague about exactly that I think, she was saying that often, we have it as a sort of tick box that we need to kind of look at that as an issue, make sure the supply chain is diversified. But actually, COVID has really made us drill down on that actually we really need to look at that in real depth, make sure that there is real diversification, that we are supporting that, because that is such a critical risk factor going forward. And I think that's been really tested through COVID. So there are, as you said at the beginning, I think some of these themes that have been there all along, but COVID has put a very specific lens on testing some of these sort of points of resilience. But I wanted to pick up on your point of risk, actually, in this kind of risk mitigation point, and come to you, Mohan. And I think, in general, this challenge of raising finance, for investment into Africa, from the global markets, etc. I mean, what are the main challenges that you find in the conversations you're having, and what are the main risk issues that come up that you feel you have to provide some sort of mitigation for?
Yeah, thanks for the question. I mean, I think Sanjeev has done a quite a good job of highlighting a lot of the risks that are involved, right? Because he spoke about the fact that there's significant exchange rate volatility and the risks that come from there, where effectively the costs are set in dollars or euro for the projects, but the repayments are going to be generally generated from local currency, even if the repayment requirement is in dollars. Ultimately the economy is in the local currency for the most part. And then he spoke about some of the credit enhancement mechanisms. The part that I wanted to talk a little bit further about was the element that he mentioned first around, the early stage element, because I think that's quite a big area that's worth expanding a bit further on. Because one of the real challenges is, yes, we do know there's a huge pool of global capital, and if anything, thanks to the significant amount of expansion from the reserve banks globally, that's been even further so. I think there was an article I was reading 2 days ago on the FT that something like 60 or 70% of global bonds are now yielding less than 2%, 20% negative, another 30% below 1%. So there's a significant amount of capital that is chasing yield. But the concern that's always getting raised is, sure, but where are these projects we're going to go into? And so one of the things that we've been doing and putting a lot of effort into on the early stage elements is working with governments to create a program approach in a number of the various sectors that we operate in, whether it's energy, whether it's student housing, whether it's in the hospital sector, even in cross-border posts in South Africa with neighboring countries, is to say, how do you take an approach that replicates successes that we can learn from other areas? So as an example, the independent power producer program in South Africa was quite successful, something like 200 billion rand, $15 billion of capex that's come into that sector, something like 7,000 megawatts of energy. But one of the successes was you had this replicable program, with standard view on the supply and demand requirements in that sector. You knew what the procurement process was, which then crowded in and brought in a number of investors coming in. And what we find is that if you can work with governments to replicate that, to give certainty to investors around how this, the investment's going to work, who's going to stand behind it, what's the role of the public utility versus the private investor, how's the decision going to be made? And if all of that is also pretty open and transparent, then it's going to be quite difficult when the government changes, maybe in 5 years, maybe in 10 years, for all of that to be renegotiated. All of that is out there in the public domain. So, we've been trying to replicate that, and we think that significantly reduces risk for investors, and it shows up in the number of investments that are getting made. There's a database that the World Bank monitors around the number of private participation in infrastructure. And I remember 1 year in sub-Saharan Africa, like 2016, there was only like 10 or 12 projects in all of sub-Saharan Africa that was registered on that database. The previous year it was 20, and that's because the IPP program in South Africa had been shut down from 1 year to the next, which completely collapsed the number of projects. So what it shows you, if you can replicate these types of programmed approaches, then you can really unlock a significant number of projects at scale. Because so it's not just one project or another, but it's many in a given country, in a given sector. So that's one of the areas that we as the DBSA have really been focusing in on in South Africa to begin with. And we're trying to do that in some of the neighboring countries and in Southern Africa as well, so that we can really unlock these projects at scale and then create the opportunities for private sector investors to come in, both equity investors pre-construction and then possibly post-construction for institutional investors to come in and take out the debt portion as well.
That's really interesting. And can I just ask, how are you measuring impact around that? So how are you kind of, measuring progress and impact as a result of that programmatic approach?
So, I think similar to a lot of DFIs prior to, 2015, 16, we were really focused on measuring our own level of investment. What's the value of disbursements that we've done in a given year? I think post that period, with the MDBs coming around with their billions to trillions paper and the signing of the SDGs, we were really focused on measuring the value of other investors that we've catalyzed into the infrastructure that we played a meaningful role in unlocking. But so that's one element, is sort of that leverage element, and we target a roughly 4 or 5 to 1 leverage in the work that we're doing overall. But also it's just looking at it sector by sector and saying, what is the gap? Let's say starting with South Africa, because that's where about 60% of our work is in. So what's the gap in this sector in our country? What is the most meaningful sets of programs? So as an example, in student housing, the government identified that we needed 300,000 new student housing beds in South Africa. So we've set up a program with the public sector, with the universities, National Treasury, and the Department of Higher Education in setting up a program approach to help universities quickly ramp up standardized student housing that they themselves own. But then we're also now working with the private sector developers to provide student accommodation as well, to support. And you can then measure, the number of student beds that's been delivered every year against that 300,000 gap that's been identified by government.
Great, thank you. And I think that, as you touched on, that kind of infrastructure sector has such a kind of leveraging ability in terms of generating additional investments across the continent. Michael, I wondered if we could just come to you to that on that quickly in terms of crowding in the private sector to the infrastructure sector. Are there particular focus areas that you're looking at around this? How can we get the private sector really focusing on some of these larger sectoral infrastructure investments?
Right. No, I think Mohan and Sanjeev did a great job really addressing on the long-term end of things. I think maybe the one thing I'd add that we sort of see coming up again and again, as we sort of talked about the risk factors, right? Whether it's foreign exchange risk that Sanjeev mentioned and ways to structure that. You could talk about regulatory risk, etc. One thing we come back to again and again is just repeating the fact that these risks are not unique to Africa, right? They are risk factors, but they're not unique to Africa. Sometimes we find that the level of the perceived level of these risk factors within an Africa context is just so much higher than it is in any other place in the world, right? And so so a lot of our work is really just educating investors, right, and just closing that gap between the perceived level of risk and the real level of risk. I think the other interesting area maybe to touch on is on the short term, trade finance end of things. I think we'll discuss on the long term end of things well. And some of the soft engagement we're doing there, again, is around the regulatory landscape, right? We think some of the engagement there in terms of making sure that the regulators understand certain dynamics and are setting in place a landscape that is certainly conducive to the private sector and it's attractive to the private sector. One particular area we're focusing on, and that has also been brought into stark relief because of the COVID pandemic, is the trade cycle that we were discussing earlier, and the disruption caused by COVID when you have airports closed and ports closed, trade finance still being so paper heavy. That's been a big part of the factor causing the trade finance gap to increase. If simply paper can't move if there's no planes, right? And so part of our engagement here with certain regulators is, as an institution, TDB tested and piloted and executed a blockchain trade finance transaction in 2019, becoming the first African DFI to do so. And we've ramped up our use of blockchain to execute trade finance this year, really brought on by the pandemic. But what we're finding is that it's not a question of technology in terms of digitizing trade, right? The technology to be able to execute a trade finance transaction in minutes rather than days or weeks has existed. Really the holdup in further digitization is the regulatory landscape, right? The whole question of, who's got where's the governing rule of law on a contract if it's signed digitally, right? For example, in some countries in Africa, a contract is only valid if the last signature on that contract is signed within the borders of that country. right? So how do you translate that now to a digital economy and trying to digitize things, right? So there's a big gap there. And it's around helping regulators understand that you can digitize some of these processes and still have the security and the safety and visibility that is important from a regulatory perspective, but still enable trade to function. And there's many follow-on benefits that come from that. So really the regulatory areas is one that we find spending a lot of time again helping regulators understand really the dynamics in the landscape.
Yeah, thanks for raising that, Michael. I mean, that's, we obviously get asked that a lot by our clients as well, and the regulation landscape and how that might change and the dynamism around that. So that's something obviously kind of we look at as well. And as you said, it's a very real and very prominent risk to investors when they're thinking, about their risk landscape. We've got a couple of questions coming in from the audience. So I thought, since we've got 10 minutes left, so I thought we should just reach out and address some of those. So the first question is around ESG values, which is actually something I've been looking into a lot at the moment. So I'd be really interested to get your views on this. So Francisca, you mentioned something, I think, on ESG values and how the DFIs have a kind of really important role to keep those sorts of commitments on the table in times of crisis. Question from the audience is how much a DFI is seeing the focus on ESG standards increase on portfolio? Shall I let you lead on that one, Francisca? And it would be good to get thoughts from the rest of you as well.
Yeah, good question. The ESG standards have always been an important issue for DFIs, and I think it's really our role to promote them and to constantly improve the standards and help our clients, our projects to step by step to improve the standards. In this crisis, sometimes people forget about it, that this is an important aspect. But as I said before, we are not forgetting about it. And if you look at the health and safety standards and quality standards, then it's very obvious that those companies and those projects which were compliant with good and high quality standards in terms of health and safety are much better off in the crisis than those who had weaknesses. I mean, where do most of the problems arise? If we look at the food industry, in particular in Germany, at the meat industry, it's where obviously not the best quality and hygiene standards and health and safety standards have been applied. There we see the highest COVID-19 cases. So it has been an important factor before, and it is important. And now we focus a little bit more on health and safety and hygiene. But once we have to live with Corona, or we can fight it, who knows? The water issues, the water risk, the climate risk will be back on the table, and therefore we should not stop working on it. Maybe now the focus is a bit diverted, but we stick to our targets and help to improve the standards.
Thanks, Francisca. And yeah, as you said, I think it's that is such a strong role of the DFIs, and I think there has been a lot of literature over the last couple of months actually that's looked at kind of ESG ratings and how companies that have high ESG ratings are actually doing better and surviving the crisis a bit better as well. So it's a really interesting. I think it's called the ESG stress test for COVID was the ESG stress test, and actually that it's actually been kind of a really positive result. Just another question that's come in, I think, and this is about this is an interesting question about kind of low value projects. And Sanjeev, maybe I'll come to you on this one. So the question is, how can DFIs improve support for projects that have a lower value? So I think the context being that there's many viable projects in Africa, but some of them can't obtain funding because of a minimal deal size, or they're not large enough. What would be your comments on that?
Yeah, I think like everywhere else in the world, SME funding as a concept is an extremely important part of any economic thinking. And I don't know how many of you know that SME funding as an agenda item actually appears in the US president's top list of priorities that he monitors usually. That's how important it is in the US, SME funding. I don't know whether it appears in the current president's agenda, but it historically has in other presidents' agendas. Now, the point I'm trying to make is that, as a DFI, I'll be very honest, as AFC, I'll be very honest, that our ability to provide SME funding directly is limited. So the way we try and approach it is clearly the lines of credit and the funding that we provide to the local commercial banks or the trade finance support that we do helps SME funding. But there's a bigger picture here. And the bigger picture is that SMEs has to be part of an ecosystem, right, Johan? SMEs can't operate in a vacuum. So, for example, when we invest, we are increasingly trying to say to ourselves, don't look at things in isolation. So in other words, for example, if you want to invest in a mine, let's see where the power to the mine is going to come from, right? And how is the mine's product going to be moved to the port? What's the road and the railroad system? And is there a port or a jetty? So if you have that ecosystem approach, that on the way creates opportunities for the SMEs, because you will need food and catering services, you will need trucking services, you will need obviously financial services, banking, you will need housing. So all of that creates what I call an ecosystem where SMEs can thrive. So therefore, that also is another way of supporting SMEs. Because I'll just make one point, if I may, slightly to digress, because I can't resist but add to what Michael said earlier on, that, projects in Africa suffer from the perception that they're risky. But data shows that Africa has the second lowest project default rates after the Middle East. Middle East has got the highest in terms of the best experience, and Africa is the second best. So that just tells you that risk from a perception point of view and from a reality point of view is different. But going back to your question, therefore, as a DFI primarily focused in infrastructure, that's the approach we are taking, because that creates the ecosystem for SMEs to thrive. But equally, I think there is initiatives like Launch Africa. I think there's one that comes to mind, which is principally looking at seeing how they can provide small loans and equity injections to startups and small subsistence-based businesses. And those, I think, we need to, in some form, aggregate up and provide lines of credit to. It's something we are not doing as AFC, maybe DBSA is doing, maybe TDB Bank is doing, but this is something that is an area that remains a gap, in my view.
Thanks, Sanjeev. And the next question is, adjacent, slightly related to this, around kind of seed stage startups. So not SMEs, but more of the sort of seed stage. And the question is around, how a DFI is responding to that need. There's no sort of seed stage VC funds in Africa at the moment. Mohan, can I come to you for a very quick comment on that?
Yeah, look, again, remember, our focus is primarily around infrastructure financing. And so it's not an area that we've focused on in the past. What we have done is, we have in the last 2 years set up a little bit of a separate division that's able to help around some of these elements. And we've been able to work. So there's a couple of these investments we've started making, but to be honest, it hasn't been a big focus. There are some seed stage funding available. There's quite a bit of it actually available, not quite a bit, but a fair bit of it in South Africa through some different mechanisms. There's a government-funded development finance institution called the Technology Innovation Agency, TIA for short, that focuses on that sector. But even they, I would say, are undercapitalized. I know our sister agency, the Industrial Development Corporation of South Africa, also has an agency, an arm that focuses more on SME financing, or the Small Enterprise Finance Agency. So they also do a bit more of that. Traditionally the DBSA's focus has been more around bulk infrastructure requirements for the country and the region. so that's where we've really been targeting our efforts.
Yeah, great. Thank you, Mohan. I think that's some interesting recommendations there for whoever sent in that question. I'm afraid we've come to the end of our session, so I'm going to have to wrap it up there. But I think it just remains, firstly, to say thank you to Invest Africa, I think, for getting together such a fantastic group of panelists. I hope that you found the conversation interesting. We've weaved through quite a number of different topics, and I think it's nice that we've taken it away from just COVID. We started it obviously with a focus on the post-COVID landscape, and I think a much broader conversation around DFIs and what they're focusing on, and the really important role they can play, I think, in the Africa investment landscape. So thank you to all of my panelists for some excellent answers, very comprehensive, and some really great insights from all the institutions that you represent. I hope that we'll be in touch soon. Thank you everyone for listening. Thank you for your questions. And I'll wrap it up there. Thank you, everybody.
Thank you.
Thank you very much, Joanna.